Spreads are the most popular option strategies. There are many types of spreads, but they each have one common characteristic. That is, in any given spread, an investor simultaneously purchases one option and sells another option on the same asset. The primary purpose of the spread is to limit the risk connected to the purchase of naked options. As always, there are some drawbacks because although spreads limit risk, they also limit profit as compared to naked positions. There are four main types of spreads: vertical, calendar, diagonal, and ratio. We'll look at vertical spreads first. In a vertical spread, both options have an identical expiration date, but different strike prices. There are two types of vertical spreads: bull and bear spreads. Now, bull spreads can be created by using either calls or puts. In the first case, using calls, a call with a lower strike is purchased and a call with a higher strike is sold. Let's look at our example. XYZ stock is at $70. We have a January call with a strike of 70 and a premium of 3, and a January call with a strike of 75 and a premium of 1.5. We create the position as follows. Purchase a January call, strike of 70. Sell, January call, strike of 75. Cost of the position: premium times a multiplier plus premium times a multiplier, equaling $150. Now, in the second case, when a bull spread is constructed from puts, an investor purchases a put with a lower strike and sells a put with a higher strike. Notice that the profitability charts for both bull spreads are the same. Now our example. XYZ stock is at $70. We have a January put with a strike of 70 and a premium of 2.5, and a January put with a strike of 75 and a premium of 5.5. So we create the position. Purchase a January put with a strike of 70, sell January put with a strike of 75. Cost of the position, $300. And that's actually not a cost, it's a credit. And as a note, as a result of establishing a bull spread on calls, we end up with a debit. This means we pay to create the position. A bull spread on puts, however, gives us a credit, meaning we have received money for the creation of this position. Bear spreads can also be created with either calls or puts. A debit bear spread is established using puts, and a credit bear spread using calls. A bear spread requires an investor to have a bearish view of the market. In other words, the investor expects the market to move downwards and wants to avoid the risk connected with the purchase of naked puts. In order to establish a bear spread on puts, an investor purchases a put with a higher strike and sells a put with a lower strike. In order to establish a bear spread on calls, an investor purchases a call with a higher strike and sells a call with a lower strike. Let's look at our example. XYZ stock is at 70. We have a January put, strike of 70, premium of 2.5. January put with a strike of 65 and a premium of 1. We create the position for a bear put spread as follows. Purchase a January put, strike of 70, sell January put, strike of 65. Cost of the position, $150. In order to establish the bear spread on calls, we have a January call with a strike of 70 and a premium of 2, and a January call with a strike of 65 and a premium of 5.5. This is a bear call spread. Position is created like this. Purchase the January call, strike 70. Sell January call, strike 65. Cost of the position, $200, and it's, again, a credit. The next type of spread we're going to look at are calendar spreads. Calendar spreads differ from vertical spreads in that they use a difference in expiration dates rather than a difference in strike prices. In general, we know that the longer an option's life, the more time value is vested in the premium. It is this feature of options that is exploited when using calendar spreads. The investor purchases an option with a life of, for example, 2 months, and then simultaneously sells an option on the same asset with the same strike, having a shorter life, say 1 month. Now, the psychology behind this is threefold. 1, the investor believes that in the short term, the price of the underlying asset will remain constant or will vary only slightly. This is a short-term neutral attitude. 2, the investor also believes that in the long term, the underlying asset will increase in price. Long-term bullish attitude. And 3, the investor also wants to limit the risk. So how does one go about making a profit with these attitudes? Well, based on the idea that options time value diminishes as the expiration date draws closer, the investor sells or writes a short-term option hoping to keep the premium when it expires. Simultaneously, the investor purchases a long-term option as a hedge to the written option and also as a bet that the stock will go up in price after the written option expires. Now, let's take a look at our example. Let's say we have XYZ stock at $80 a share. There's a June call with a strike of 85 and a premium of $1, and a July call with a strike of 85 and a premium of 1.5. So we create it as follows. Purchase the July call with a strike of 85, sell the June call with a strike of 85, and the position cost, $50. In the phrase, the short-term option is overvalued in comparison with the usual situation, how can we tell if an option is overvalued, undervalued, or within its normal range? Well, there are complex statistical methods for determining these factors, called option pricing models. These models calculate the theoretical value of an option. There are several such models, of which the most popular are the binomial Cox-Ross-Rubinstein method and the Black-Scholes model. The binomial model is considered to be more precise. However, the majority prefer to use the simpler Black-Scholes model, as the degree of its accuracy is sufficient for the individual investor. The use of models is a must for serious options traders. Any serious computer program designed for option trading incorporates option pricing models. Later in this course, we'll study them in detail and learn how to apply them practically. The last type of spread we're going to look at are ratio spreads. The primary difference between ratio spreads and those we've already considered, vertical, diagonal, and calendar spreads, is that with the former, we purchase and sell equal quantities of option contracts. Now, the following is a ratio spread using calls, call ratio spread. In this, an investor purchases a given number of calls with lower strikes and sells a larger number of calls with higher strikes. Our example would look like this. XYZ stock is at $100. We have a March call with a strike of 100 and a premium of 4, and a March call with a strike of 105 and a premium of 2. So, a bull call spread is created like this. Purchase 2 March calls with a strike of 100 and sell 2 March calls with a strike of 105. Cost of the position, $400. Now the call ratio spread looks like this. Purchase 2 March calls, 100. Sell 4 March calls, 105. Cost of the position, nothing. The psychology of this strategy is similar to that of the vertical bull spread. However, there are a number of basic differences. Using the ratio spread, the investor's attitude is far less bullish than would be the case if using a vertical spread. On the chart you can see that the investor gains the maximum return only if the underlying asset increases slightly in value and does not cross the higher strike. The holder of a vertical spread would receive the max return even if the higher strike were surpassed. The limited return associated with the ratio spread is compensated for by the complete absence of cost, except for commissions and a temporary margin for short options, because one sells a greater number of calls than one buys. Now let's look at ratio spreads using puts. This strategy requires a bearish view regarding the underlying asset. However, it is not as strongly held as in the case of the typical vertical bear spread. When utilizing the put ratio spread, the investor purchases puts with higher strikes and sells a greater number with lower strikes. Now our example. XYZ stock is at 100. We have a March put with a strike of 100 and a premium of $4, and a March put with a strike of 95 and a premium of 2. So, we create the position. The first we'll look at is the bear put spread. That's purchase 2 March puts 100, sell 2 March puts 95, cost of the position $400. But the put ratio spread looks like this. Purchase 2 March puts 100, sell 4 March puts 95. Cost of this position, 0. All that we discussed about the psychology behind the call ratio spread applies to the put ratio spread, bearing in mind that the call ratio spread is based on a bullish attitude and the put ratio spread is based on a bearish attitude. The next spread we're going to look at is back spread using calls, or call back spread. With this strategy, the investor purchases a greater number of calls with higher strikes and sells a smaller number of calls having lower strikes. You'll notice that this is the reverse of what is done when creating a call ratio spread. Our example. XYZ stock is at 103. We have a March call of 100 with a premium of 5, and a March call 105 with a premium of 2. So our call back spread looks like this. Sell 2 March calls 100, purchase 3 March calls 105. Cost of the position is a credit of $400. It should be obvious that the call back spread is an extremely bullish strategy. In this example, we can see that the investor believes and wants the price of XYZ stock to surpass the higher strike of 105 in order to take the best possible profit. It should be noted, however, that the creation of this particular call back spread creates a credit of $400. Therefore, the investor would be quite content if, on expiration, the price of XYZ stock was below the lower strike of 100. Now let's look at back spreads using puts. In this strategy, the investor purchases a greater number of puts with lower strikes and sells a lesser number of puts with higher strikes. Our example. XYZ stock is at 100. We have a March put 100 with a premium of 3 and a March put 105 with a premium of 6. So our put back spread looks like this. Sell 2 March puts 105, purchase 3 March puts 100, position cost, a credit of $300. The psychology behind this strategy is that the investor believes that the price of XYZ stock will fall drastically, and if this occurs, the profits are practically unlimited. However, there is no tragedy if the stock price increases because both the long and short options will expire worthless, and the investor keeps the $300 credit.